we are going to get the recording started, and it looks like it has started, and we'll go ahead and get to things. Again, everyone, welcome to today's call. We have quite a bit that I want to cover in today's call, and I'm going to cut it off at exactly an hour. So that means I'm going to just fly through this introduction here to make sure that we get enough in the material and enough to answer some questions. This is the last TPO call before the seminar starts on Friday, this Friday, coming up fast. The next TPO live call will actually be in the seminar, during the seminar, I should say. So that will be the next one. You will have a link for that if you did not get involved in the seminar. And so if you have not already, I would strongly suggest that you call Spring to go ahead and get signed up for that. And we're going to be covering a lot. I'm not going to go over what we're going to be covering again because I've already stated that several times. You can watch some of the videos on what we're going to be doing, okay? All right, so for those that are new on the call, welcome, and I do want to welcome you, but I do want to also caution you, I don't explain everything about these trades on this call, nor is it even possible to explain everything about these trades on this call, as you will see from the seminar if you attend the seminar. And so if you're coming on, you're expecting to completely understand everything that we're talking about in this call. At the end of it, I can tell you that that's not going to happen. So you will see enough to understand that there is a very, very, very high probability of being able to succeed with this if you approach it right and you have the right foundation. And so it's well worth continuing on these calls. Now, if you do, I do also want to warn you that these trades are fantastic, but they are not foolproof. They're not guaranteed. There's always risk, and you can make mistakes. And this is not something that that you're going to find anywhere else. So it's going to be brand new to you. And it doesn't matter how long you've been trading, but you want to start small because you can make mistakes, and because there's plenty of room for growth, plenty of time for growth. And I'll get to that here in a second. You don't want to be reckless with how you put these things together. You're going to understand the concept, but you can't just throw anything together that you want if it meets the concept. There are very specific structures that can be done and need to be done. Then you need to follow the instructions, and that's very, very important, and that is for your protection. Even I cannot get out of the consequences if I don't follow my own instructions. So great trades do not mean that you can just throw caution to, does not mean that you can just throw caution to the wind. Okay, now why even if you have a $100,000 account, why do I say you should start slow? Well, I say that because of the compounding effect. And if you apply these principles and this strategy to the compounding plan that I provide, which is right here, the growth of this over the long haul is absolutely spectacular. So this is just assuming a $2,500 account to start with, and you can do that with most of these trades easily. And if you can get to the point where you're averaging $100 a week with these trades, and then you apply the compounding to that on top of that, you're talking about within a 6-month period of achieving $100 a week on average, non-compounded, and then compounding, you're talking about $30,000 in profit, starting with a $2,500 account. That's tremendous. And if you're able to continue on with that average $100 a week, then you can grow your account to over 3 million, and that's conservative. I actually have a slightly more aggressive compounding plan for those who understand what they're doing and understand the strategy and the approach and have experienced some consistent success. You can actually be a little bit more aggressive with the compounding plan, and those numbers actually grow to be astronomically larger. So that's what we want to focus on. Is we want to focus on the compounding and the small, consistent success. And along those lines, after getting some trades over the last couple of weeks and dealing with some things that some of you guys are having a little bit of trouble grasping, or maybe you're just not quite clear on it, or you're not quite clear on the exiting or whatever. What I want to do today is I want to talk about getting a better price and slowing things down. So, for example, some of you were putting together some of these trades in what I call my $1 million option pattern, which is a basic thing that we've been talking about over the last several weeks, over the last almost 6-7 weeks now, because it has been available. But last week it wasn't quite available to where you could just get in and get a credit. And of course, I'm always trying to get a credit. That's preferable. It doesn't have to be that way. You can take a small risk to the downside. There are certain patterns where you can do that, and you're talking about a $20 risk to the downside with significant profit potential to the upside. Certainly is there. However, sometimes you can't get the credit with the two, and so in order to get the credit, some of you have spread the strikes out a little bit. And if you have been watching it in any length of time, you know that the further away the short strikes are from one another, the bigger the dead zone is. And when we have a dead zone that is above where the market is, we know they're going to crater the volatility if the market moves up and into that dead zone, and then you could be in trouble. Whereas the projection graph at the time you enter shows a clear profit because you stretch the strike distances out a little bit. You actually created a dead zone there that has to be addressed. And if you don't know how to address the dead zone, don't do that. It can be very tricky sometimes. Once you get the hang of it, it's not as tricky. But if you're not used to that, I wouldn't put myself in that position at the beginning. All right. So what do you do when you can't necessarily get the prices that you're wanting to get? And there are several things you can do. Right. Number one, you can go ahead and get the bearish or the bullish and then wait for a better price on the other side of it, right? Certainly you can do that. The problem is that if you're too close to the money, so for example, let's say you enter into a bearish and you're going to wait for a bullish, and some of you have done this, and sure enough, the market moved up as soon as you got into the bearish neutral, I should say, and you were never able to get the bullish, or at least it made you sweat some. Right. So several weeks ago, we got into a bearish. I think it was like on Thursday, and we didn't get filled on the bullish until like Tuesday on one of the trades. And so, sometimes it can make you sweat a little bit if you do that. And I say sweat because the risk on the bearish neutral is going to be a little bit bigger, but it's still way up there as a general rule. And so what can you do? And furthermore, there's been some issues with exiting and how to exit. And I've tried to cover that a couple of times. So Thursday morning, we got into a trade the previous weekend on Monday, and then Thursday morning, we're normally seeing some sort of profit with these usually after the big announcement for the unemployment, which it's kind of hijacked the numbers over the last 6 or 7 weeks. Ever since we got that massive surprise in the unemployment, the numbers jumped. Positive surprise, I should say, and then the market just shot up 10 points, literally overnight on this report. And ever since that, the market has been maintaining its value in the options through Thursday morning. And so Thursday morning we get in, we're in this trade and market's moving up, and we're kind of in no man's land. we're in between the bullish trade and kind of where the bearish trade begins to lose a little bit of money. And we weren't able to take a profit Thursday morning, and some of you panicked and you got out anyway. And then the market came down on Thursday afternoon. Everything shows a profit. Everything that we were in shows a profit. There's more profit on Friday, unless you created a debit on the trade, at which point there may not have been more profit on Friday, but market was down a little bit on Friday. So there's ample opportunity to get out Thursday afternoon and Friday morning. But some of you, because you couldn't get out at a profit on Thursday morning, you panicked and you got out and maybe a break even, maybe a small loss. And there was no reason to, because you're right. You haven't even gotten to the bullish profit zone yet, right? And the market was trading around 326-ish, and the profit zone was like the big profit zone started at around maybe 328, I believe, if my memory serves me correctly. So we were right kind of at the edge of between the two, and I think there was a dead zone there. It was a very small dead zone, but dead zone nonetheless. Dead zone danger is mostly on Friday. That's where the dead zone danger is. So, given Thursday, we still had 2 full days. The market could have moved up into the profit zone. Market could have moved down to where we're going to capture some profit because we have a credit overall on the trade, and that's what it ultimately did. And so, you're faced with exiting on whether to exit on Thursday, the day before, or wait until the afternoon, or wait until the morning. All right, so I said all of that to set us up for what I'm going to introduce today, was just a little bit of a different way of going about this. It might be a little bit more in tune with allowing you to get used to seeing these things, and in doing so, then you might be able to put together a pretty good plan for yourself on how you're going to implement this pattern in the future. And this is a suggestion. It's something that I do. It's not my main approach with this approach, but it is something that I've been focusing on one account with, and it's done very well. On a larger scale, it's one of the bigger accounts that I do this with, less activity. So what I want to do is I want to show you something that I did last week. So here is my bearish trade, okay? And everybody should be able to see that. Here's my bearish neutral trade. And you can see this bearish neutral trade is way up there. Just from this graph, where do you think the strikes are? And you should be able to, by now, if you've seen this enough, if you listen to me enough, you should know exactly what this trade is, or very close anyway. A really good, solid guess based on what I do for my bearish neutral, right? So the profit peaks are always at the short strikes. So here's a profit peak. And so that profit peak is at 328. So guess where one of my shorts is? 328. The next profit peak is at 331. So there's my other short strike. And then knowing that my bearish neutral is generally one strike above, then then you can probably put together, this is a 328, 331, 332 bearish spread, okay, bearish neutral spread. Market's trading at 322. I got in at 95 cents. These are exact fills. So I put in the correct fills, actual fills, And this was on a much bigger trade size than just one, but but I brought it down to one so you could compare apples with apples on what we're doing, how we're doing it. So this is the bearish, right? So this is what it was, and this is a 731.83, and the 328s for 247, 331s were 152, and then the 332 longs, two of them, were at 152 as well. And you might be saying, wait a minute, those are awfully expensive prices for those. And they're not anywhere close to that right now. And that is exactly correct, because I put this trade on like last Monday, going 2 weeks out, when the market was trading. I think it was Monday. It was when the market was trading at around where it is right now, a little less than 322, I believe, at the time. And I was able to put on 328, 331, 332 bearish neutral spread for 95-cent credit with 2 weeks to go, essentially 2 weeks to go on the trade. Okay. Now, why would I do that? Why would I do that? A couple of reasons. First of all, when I do this, I have a huge probability that I'm going to be able to do something about the risk at some point before this trade ends. It's not an absolute guaranteed, but it is a high probability. And of course, if the market does skyrocket instantly, then I could be in a bit of trouble if I did not plan for the risk on this trade without having some sort of bullish offset. Okay. However, the probability of realizing the max risk on this trade is so small. We're talking like 2% is probably aggressive. Okay, and the reason is because I'm not just going to sit here and hold this indefinitely until the market, potentially moves up into the, 337, 338 area, which is the level of where I'll see the max risk on this particular trade, which is about $400. So I have a very, very low probability of it going up there in the first place, but I have an even lower probability of me suffering the maximum risk, because between now and then, I'm going to be able to do something with this trade. And this kind of slows things down when you're able to put on these trades that are way out of the money at the time, and the break even is way out of the money, and then just kind of be patient. Then some things can materialize that allow you to enhance the trade considerably. Now, one of the things that I like to do is I like to make sure that if I get into a trade and I'm going to enhance the trade, which is basically what, by the way, when I talk about enhancements, basically adding a bullish trade to this is an enhancement, right? So you're already in the process of enhancing a trade. And again, I'll cover this in detail in the seminar. But the more time you have to enhance the trade, the more distance you have for the market to move to enhance the trade, the more calm you can be about it, and the more patient you can be about it. And I've always said, patience in this market pays off. Sometimes we're a little bit too eager to create this perfect trade with no risk, and we end up really basically neutering our profit potential. Okay, I have found that I am much better off. I do much better willing to take a little bit bigger risk than trying to create this perfect looking trade with only $100 risk to the upside, and the market has to skyrocket to the upside. Well, that's great, because all I'm looking to make is $20, $30 off of that type of scenario. If I can make 40, it's a bonus. If I make 50, it's a huge bonus. with a 95 to 98% probability of being able to do that. And if I can't do that, worst case scenario, market skyrockets, I lose $100. There's a place and time for that, and it's a great trade. But you're not going to make, you're not going to get to where you're making $100 a week off of that pattern. And so, that's a starter pattern, and you got to make sure that you're doing it right. And then even when you do it right, that doesn't mean you're going to you're necessarily guaranteed to make 20 or 30 or $40 profit, depending on how far your short strikes are. And I'm going to repeat that again. If your short strikes are pretty far away, you're going to be having trouble putting together a consistent $30, $40 profit. You might be able to get 20 out of it. If it goes through the bullish zone, you might be able to get 30 or 40, but it'll have to go through that bullish zone for that to happen. And then even then, again, it's not guaranteed. So what this does is, you're technically risking $400 on this trade by doing it this way, but you have a lot of time to be able to address that, and it's something that is easily addressed if the market stays the same or moves down. Even if the market moves up, you'll find that that there's still options available. You have choices that are there that can diminish the risk. So, for example, on this one right now, if I want the break-even level on this one is at 332-ish, and let me see where the market is trading right now. And let's see. If I wanted to put a hedge in place, a 332 hedge, what would it cost me? And it would cost me 17 cents. Okay, cost me 17 cents. So I can put a long hedge on, expires on 7/31, and I can do that for 17 cents. And I'm going to be limiting my risk. It's going to be far, far less than $400. At this point, it would probably be about $50. If it goes up to 332, my max risk would be about $50 ish. And that's, we're a week away, not quite a week away. It's Monday, so the thing ends on Friday. But because I placed this on a week ago, that's something that I can do for 17 cents, and I can have a hedge there. More importantly, what I do with these is I just wait a little bit longer to get my bullish trade in place, to make sure I have a credit, and I wait to get my bullish trade in place. Now, there are some times, like today, for example, where this particular trade, I entered in at a credit of 95. It's trading, right now, it's trading at a credit of 30. So I'm making $65 on this trade right now. And if I wanted to, I could just simply put this trade on every week and exit at a profit target, not do anything else. I mean, it could literally be that simple if you're willing to risk every now and again $400. And eventually, if you don't have this planned out, you might lose $400. Or if the market tanks and you put this trade on, and then the market comes right back up and goes into your risk zone, you might lose $400 on this thing. So this is something that's not necessarily, if you're starting with $1,000 account, you can't do this with this particular trade. You need to do something with a little bit less risk in order to do that. Again, part of the max risk is not just, if you look at let me show you this again. All right, if you look at the money management table, the compounding table, I say here max risk is $150. This is, and I talk about this more again in seminar, but this is not an absolute hard number. It totally depends on what the probability of realizing that max risk is. If I have a max risk of $200 on a trade, and in order for me to realize that $200 risk, the market has to move up like 5%, 6%. I have no problem taking a $200 max risk because I know that sometime before that move or during the move, I'm probably going to be able to do something with that trade and not risk $200 or whatever. And so if I get up here to $2,800 and I have a max risk of 450, what's the probability of that happening? And I'm going to be a little bit more lenient with that number if it's way up there, but you have to make sure, you absolutely have to make sure that you're not creating that risk in a dead zone, which is much closer to where the market is. So there is that one caveat with that. But with this one, we know there is no dead zone. It's only a matter of where's the break-even level and how far away is that break-even level, and that's about it. Because if the volatility drops on this one, and it will, the break-even level will be probably around 331-ish. Maybe between 331 and 331 and a half, something like that. So it's not that this increases the risk at all. A volatility drop does not increase the risk on a single trade like this. It won't. Excuse me. It only changes the break-even point by a little bit, and all of a sudden my voice is about gone. Hang on one second. Sorry about that. So there are a lot of stuff can be done with this, because when you go out a couple of weeks, you're giving yourself more time, you're giving yourself more room, and you're giving yourself a higher probability of being able to do something with the trade. So one of the things that I did with this is and I didn't do it with all of them, but just to show you, is I did do a bullish trade, and I did a bullish trade at a cheaper price than I could have done it at the time of the that this was placed on. It was only probably maybe 25 cents different, but I put on a single bullish trade, and the bullish trade was just a simple 330 short, 328 long. Okay. Now look where my short is with this one. My short is 331. Okay, my short is 331. My short on this one is actually less than my short on my bearish, my last short on my bearish, right? So that's going to create another profit peak. So there's not going to be a dead zone there, and I know there's not going to be a dead zone there because my short is actually, of my bullish, is actually one strike less than my than short on my other bearish. And the reason that I was able to do that is just simply because I waited a little bit, and it was filled. And so by adding just one bullish, where the short and the long are actually within, both the short and the long are actually within my bearish, then I'm going to create a scenario. And this is after I drop the volatility out, by the way. I'm going to create a scenario where the market has to move through this profit zone. I don't care about this risk up here at this point. Even though it's not that bad, I don't care about it because I know the market's going to have to go through this bullish zone, and I've already dropped the risk on, or excuse me, the volatility on this, right? So I put the volatility is showing at like 16%, and I dropped it down to 13 on both the 332 and the 328. And so this is with the volatility coming out, and here's where we are, and the market has to move up and go into that. Now, I created a 2-cent credit. So what happens is I went from making money right here. I went from making money here to possibly not making hardly anything if the market stays here. So this Friday, I would have made at least $95 on this trade. And this Friday, based on this, I might make $15 on the trade or something similar, okay, or something a little more if the market moves higher. And it's going to have to move significantly higher for me to reach the $60, $70 profit level, which is what I can take this bearish trade out for right now. And this is not, by the way, a bad strategy if you're willing and able to, at some point in the future, take a $400 loss on this trade. At some point, it's going to happen. I don't know when. You might put together, 40 or 50 wins in a row, which I've done before when I go out of the money on stuff like this. My streak is actually 54. 54 winners in a row, not with this particular pattern, but with a pattern where I go way out of the money. So that's that's pretty significant. I wouldn't put this on every single week the exact same way. If the market's down, I want to give it some room, right? So there's a lot of different opportunities, though, if you want to do something different with the trade. I could have put my bullish on, by the way, which is the normal bullish would have been based on these strikes. The normal bullish would have been a 335 short and a 333 long. And those right now, just to give you an idea, what did I say? 333 short and a 330. You're not seeing what I'm doing, by the way, because I'm doing it on a different screen just to tell you what it is, not because I want to go over it. So 335 short and a 333 long, I think is 335. Nope, 333. Or excuse me, 334. All right, hang on, I'll move it over here. 334 and a 332. This is the normal bullish trade that if I did 2 of, I would have gotten about 0 cost basis at the time that I put on the trade. And I'll show you that here in a second. So this right now is trading for 26. And in reality, the 34s are only going for 7 cents. And so I'd probably just pay for the long. And then if I can get the short, at 34 cents, if the market moves up, then I'll sell the short. So I'd probably just do a long here, and that is more than enough to cover the risk, right? If I do a 332 long that expires on August 3rd instead of a 731 long, then I'm going to have some value here at 332. It's going to be worth, if I pay 34 cents for it and the market moves up to 332, I'm going to make $100 on that long. And then it's just going to keep going up from that point, right? So, in fact, if I were to do that, if I were to show you that right now, so we'll go 332. And this is just an enhancement. That's all it is. So 332 added to that bearish based on the price right now creates almost a risk-free trade. It's not quite risk-free because this dead zone is below 100, and I have 3 longs that create this dead zone. And so that technically could drop to a break even, maybe a little bit less even if the market were to move up there, but of course we wouldn't hold until that point. So by adding that, I still have a 62-cent credit, and if the market moves up, I actually can add to my profit a bit. All right, so it's just an enhancement. And that's the key, by the way, with enhancements. And it's also something that is very, very beneficial when it comes to profit stacking, because the more time you give yourself to be able to create a risk-free trade, for example, and then stack the profits, the more you'll be able to do it. The higher probability is you'll be able to do it. Okay. All right. So, having said that, let's zero this back out. This is not an uncommon strategy to be able to take advantage of. You can put this on, and you can put on a $60 target, and you'll probably hit that $60 target unless the market skyrockets. You'll probably hit that $60 target within a week. So instead of this being a 2-week trade, right, because we're wanting to average a certain amount of money per week, instead of this being a 2-week trade, it can be a 1-week trade, because this is a time decay based trade. The bearish neutral is a time decay based trade. The bullish that we normally put on is not a time decay based trade. It's just simply the hedge. It's the enhancement. All right. So in looking at those, I'm going to bring something in here. I want you to notice something. I'm especially inclined to take this type of approach now, because the market is trading higher from the standpoint, I know it's not from higher from last week, but higher from the standpoint of where we have been over the last several months. And we still have junk going on financially. We still have August, which is not the greatest month for stocks. We still have an election coming up that are going to weigh on things. And so, if I can put on a trade that is high probability from the standpoint of it's way above where the market is in the current conditions, it increases my probability all the more. And so I have no problem doing something like that, especially if I have a plan for doing something about the risk and maybe adding to it or taking a profit, being aggressive with taking a profit. Here, I want to show you something. So that was a what did I say that was? That was a 328. Okay, we got it for 95 cents. Here's the 323 this week. Here's the 323. And this is basically at the money. Okay, 323, 326, 327. So if the market moved up to 328, so if the market moved up and we're trading like right at 328, guess what? I have a small loss on this trade, right? Well, we're trading here at the profit peak, but because we are still 4 or 5 days away, there's still a lot of value on that. If I get into this at 95 cents and a week later we're trading up at the profit peak, then I can expect to be losing, $30, $35, maybe even $40 on that trade. That's a lot less than 400. And at that point, if I wanted to, I could add on to the trade if I wanted to. Or if I wanted to, at this point, I could add a bullish. Okay, the current bullish one that I would add to a 328, or the bullish that I did add to the 328 where the short was 330. It's trading at 72 cents, 71 cents. So it's still less than my 95, and all of a sudden now I have a bullish trade. And if the market closes at 328, okay, so this is representing if the market goes up to 328 on this other trade. If the market goes up to 328 and my 328, 331, 332 spread is trading at a credit of $1.32 instead of 95 cents, I'm losing basically 35 cents on that. I can put on my bullish, which is again, right now it's at 71 cents, and this would actually be a let's see, 5 points away. This would be a 335, 333, and I could put that on, and I could reduce my risk on the overall trade. Okay, or I could just hold on to it, or I could look for a some sort of hedge. Right, so the market's going to move up, and you'll have to make a decision. Before you actually get involved in the trade, the market will have to move up, and then you'll have to do something, or you'll have to accept the risk. And of course, you can always just get out of this trade and for a $40 loss and go further out of the money and push it, and maybe a $40 or $50 credit, go further out of the money and push it that way. Or you can go the following week, count that as a $40 loss and go to the following week. I'm less inclined to do that, because if it moves up, at 134, if it moves up to 328, which is where this short strike is, if it moves up to 328 and I'm losing 40 bucks, guess what? If it stays there for the next 4 days, this is going to go to a debit, and I will make more than the $95 credit on that trade. Right, so all sorts of stuff you can do. Okay, so let's take a look at a couple of different ones. Here's 8/7, expires on 8/7, 8/7, 8/10. And you can see it's 323, 326, and 327. Same as what I did up here. This one's at 133. What's this one at? 184. I go 1 week further out, right? Instead of this week expiring, it's 1 week further out. Instead of 132, 133, it's at 184. So guess where this trade is going to be at in 1 week? Approximately, if the market goes nowhere, approximately 130. So I should be making about $50, $55 if the market goes nowhere in 1 week with this particular trade. If we go and take a look at the bullish on this, which is a 330, 328, right? And this is the furthest away bullish I'd be willing to take on this trade, because the strikes are 4 points away. This is trading at 94 cents. And I would be inclined, so 94 cents, 184, so I'm looking at basically 190. So I would be inclined to put this in at like 185, and then put my bullish in, and I could do 2 of them at like 90, and I would have a zero cost basis. And I'm very close to that, very close. And it may not happen today, but I have 2 weeks on this thing. And so that would be the most conservative approach to it. And more likely, what I would be willing to do is I'd be willing, and again, this is 184, so this is like right at the money, right? So this is not what I was talking about as far as going further out, but I just want to show you that even if it's at the money, you can get a better price by going further out, because this one right here at 130 and 70 is trading at a debit of 10 cents. All right. So debit of 10 cents. You can get a little bit better than that here. Not much, but a little bit better than that. And then you have, but you, more importantly, you have a higher probability of being able to do something with this bearish. But if you go further out, let me push this here to the 327s. I like going and going out where I can bring in about $1 credit. And so I can push to another week out, 8.7, 8.7, 8.10, and I can go 327, 330, 331. That's my bearish. Neutral is trading at $1.11. I can probably push that to 328. Let's see, 328, 331. So this is basically what I have this week that I put on last week, and then a 332. So that's 96 cents. So that's right exactly what I got last week. And the same one right now is trading where? It's trading, oh, I don't have it on here, but it's trading at about 30 cents. So it's trading at a $65 profit, okay? And that's going out of the money. If I were to go even one more week out, I could go with a 331, 334, 335. And this one is going way out there, but it's also, you know, basically 2.5, almost 3 weeks away. But my short strike, my last short strike, is literally 11 points above where the market is. And so it's not that it can't go there, it can. It's that what can I do on the bullish side for this? And what's the probability of me being able to get a better price on a bullish trade in the next day or 2 or 3 or a week? And it is very high. All right, so and again, I'm more inclined to take the profit. Take the profit at the end of the week. I don't, you know, even with this one, I can go 3 weeks out and I can exit in 1 week, right? If I wanted to, and because in 1 week the 331, and this goes back to the comparing prices that we've gone over the last couple of weeks, so everybody should understand what I'm doing here. 331, 334, 335. And it's going for about a $40 profit. Super high probability that I'm not going to suffer the risk on this trade. Very high probability that I'll be able to take a $30, $40 profit in a week. All right. Maybe sooner, because if the market moves down after I get into this trade, I will have this opportunity sooner. And then you can just bank it and reset. If you know, if you want to be that simplistic about it. So getting better prices is oftentimes available when you're talking about a bearish neutral trade, oftentimes available by going out a little bit further. And that better price allows you to do a lot of things. Allows you to go further out of the money, allows you to wait, be a little bit more patient for the bullish. And again, yes, you're risking $400, but like I said, and $400, we're talking about the market going to 340, okay, to risk this $400 on this 814, 814, 817. We're talking about the market going to 340 and not doing anything beforehand. And that's would be smashing through all-time highs. Can it happen? Yes. What's the probability of it happening? And happening in such a way that doesn't allow me to hedge or diminish the risk in any way, shape, fashion, or form? Very, very, very low. So I don't like to play the no risk game type deal when I put these trades on, because there are certain probabilities that are at play, and I like to play the probabilities. And you will be better off by doing this and willing to accept the risk of this happening once or twice over the course of a year period, and then just putting on these trades and taking it off at a profit, or doing something to hedge the trade at some point during the first week, and then creating a profit stacking opportunity. So if you're trying too much to create the no risk scenario, maybe you just need to slow down a bit, push things out a little bit further, be willing to take a little bit bigger of a risk, and slowly go from there. Okay, just a suggestion. Again, I'll cover more of this in the seminar. All right. So I did want to do one last thing. So here's the 331, 334, 335. That's 1 week out. It's 52-cent credit. By the way, I could do this 731, 731, and 83. I could do this 1 week out, get it 53 cents. It's way up there, 53 cents, and guess what? I still have a $40 profit on this thing by 1 week today, 1 week from today. Okay, now if I go 52-cent credit, I am technically risking $448 if the market were to skyrocket. But again, we're looking at the market skyrocketing an awful lot, and I can already on this 87, 87, 810, I can already go with a hedge that's going to diminish that risk. It's going to diminish the credit, but it will absolutely diminish the risk on the trade as well. So for example, an 87, 330, I can go with a 336, for example, for 35. And that's only one, so I can add another long for 35 cents, create a total credit of 15 cents, and all of a sudden I do have a dead zone at 337, but it ain't $400. It ain't a $400 dead zone. And again, we're talking about 337 when we're trading at 322.48 right now. Okay, so tell you what I will do. And I'll update this. We're going to go as conservative as we can be on this thing. And we're going to go 814, 817, just so that we can do it and watch it together. Whoops, 814 and 817. And we're going to put that in at a credit of 95. So it may not get filled today, but that's what I'm going to do. I'm going to credit of 95. And then what I'm going to do is I'm going to get rid of that one. And I'm going to do a bullish with my short at 335 and my long at 333. And we'll just watch it. There we go. So I'm going to go 814, 817. All right. I said I was going to do a what did I say I was going to do? So I was going to do a 335 short and a 333 long. So we'll go short 335 and long 333. And that is going to give me a profit zone an absolute profit zone, no dead zone, a profit zone. I could do that right now at 62 cents, create a 20, almost 20-cent debit, or excuse me, credit on the trade. And it will create a profit zone if it goes up to 335, because my 333 will be in the money by 2 points. And I will be at about a break even here. But I'm not going to do that. I'm going to go, okay, if I can get that one for 95 cents, then I'm going to do, this one for, let's see, if order 1 is filled, I'm going to execute this one at a debit of 50. And I'll do a GTC. And what I will do is I will also say, oh, no, sorry, hang on. I need to do another action group for that. I will also do this. You know what? This is what I'm going to do. Yeah, I'm going to change it up. Sorry, guys. So I'm going to say I'm going to get my bullish for 40-cent debit. But if I can take a credit first, then that's what I'm going to do. Or I'm going to take a profit first, then that's what I'm going to do. So guess what? I'm going to go inverse. And I want to say if order 1 is filled, then I'm going to say execute order 3. And I'm going to do it at a debit of, if I get in at 95, I'm going to do it at a debit of 60. And that'll give me a $35 profit on the trade. Okay. $35 profit on the trade. And I'll do that for GTC. And so I've got two things working. I've got this this bullish trade that will be working, but if this bullish trade isn't filled, then I'll have this exit order in place. And so what I'm going to do, and this is the beauty about Trade Partner, what I'm going to do is I'm going to say, okay, if order 2 is filled, right, which is my bullish, then I'm going to cancel order 3. And then I'll say if order 3 is filled, then I'm going to cancel order 2. All right. So what is that doing? If I get filled on my bearish bullish, on my bearish neutral trade, which is way out of the money, then I've got a profit target working, and a bullish trade working. Why is that? So this would be a debit. Okay, so I've got the bullish trade working and my profit target working. And I don't want both of them to be filled. So I want to say if one is filled, then cancel the other. And if the other is filled, then cancel the one. And that's what I just did. And I don't have to watch it. So save. Now the market is going to have to move up a little bit for this to get filled, but that's fine. Give me, let me click OK on this. All right. All right, so I'll turn that on and then we will get to questions because I said I was going to cut it at an hour and we are 1 minute away. So open one bearish, 323, 326, 327. So 326 and the bullish was 331. Tim, you've created a dead zone. You went way too far with the bullish side. So your shorts are 5 points apart. Your last short on the bearish is 326. Your first short on the bullish is 331. That's 5 points away. That's 4 points would be my absolute minimum, and I'd rather do 3 points. I'd rather get that bullish down, which is one of the reasons why I went and showed you guys going a little bit further out in time, because this stuff is weird right now. In the last call, I briefly touched on exiting the bullish first, but I'm not understood the entire comment. I feel like often when I exit, I'll get out of one leg and then the other leg runs completely away, and I have to change it out. Okay, so Ryan, I only exit the bullish first if I'm in the profit zone of that bullish. There's zero reason to exit the bullish first if you're not in that profit zone of the bullish. Zero reason. So that's the only way I'm exiting a bullish first. In like 99% of the cases, I don't want to be absolute, but in like 99% of the cases, it has to be going through that profit zone. So I have to exit at a profit, and the profit needs to be more than the minimum that is available with the bullish. So let's say if the market really screams to the upside, my profit potential is only $100 on my bullish, then as it's going through the profit zone, my target is going to be more than $100 for that. Okay. All right. The seminar will be posted. The recordings will be posted and available like on Monday. Let's see, what is the average move for SPY in 5 trading days? Do you use the expected move or ATR to judge the probability of a bearish neutral trade? That's a great question, Keith. The easy, the quick and dirty way of looking at a probability is to look at the delta of an option way up there. So, for example, at on this one, if I look at the one that's on the screen, if I look at the delta of the 817, or excuse me, the 814, 335 strike, then that'll give me a rough probability that is being determined on the market moving up to 335 by 817. And I'll pull that up real quick and tell you what that is exactly. Does it make any sense to go further out in the longs, take a little more risk to get faster theta decay between short and long? You just have to be aware. You just have to be careful of the dead zone. You know, anytime you spread this stuff out, you got to be careful of the dead zone. So let's see, the 335 is, let's see, where are we at? Which one is this? So on August 14th, the 335 delta is at 16%. And so basically there's an 85% chance that the market will not close at or above 335 by 814. Okay, now let me explain why this probability is much better than that. The probability is an 85% chance that the market is not going to get to 335 by or on the close of 814. Okay, 85% chance. We're not playing that. That's not what we're playing. What we're playing is what is the probability of being able to reduce the risk. And that's, by the way, about the break-even point. If we go to the max risk on this trade of, let's say, 340-ish, it might be a little bit lower than that, but around 340-ish on, that is a 6% shot. Between 6 and 7 of the market going to 340, but that is purely a number statistic. It does not take into account any of the fundamental issue aspects that we've got going on right now. That's assuming that the market can just as easily go to 340 as it can to 310. And or three, no, it's actually can just as easily go to 340 as it can to 300. And that's simply not true from a standpoint of characteristic, talking about the characteristics of current conditions and market conditions. All right. Yes, I will send this out. Oh, I forgot to turn it on. So I'm going to turn that on. Oh, nope, not that account. Wrong account. So do this one. And I will send this out as soon as we are off here. And I'm not necessarily saying everybody take it, but if you want to see how it's structured and you want it as a template, how it works, you can do that. Let's see here. What should you do here? I would look to, well, you have a credit of 8. I would look to take a small profit, and I'm talking to the gentleman who gave me his exact trade, and I said the shorts are too far apart. And then I would make a plan. If you don't get filled on a target, a small profit target, I would make a plan to address that dead zone at some point. Seminar login details are working on it. I think the final test is tomorrow, so assuming that nothing goes wrong with the test, it'll be probably on Wednesday. Tim, I will take a look at that because it should absolutely, the short should not be 5 points difference. Okay, you did 5 points different. So that's the minimum. 4 points is the minimum. I'd rather do 3. Okay, 4 points is the minimum. You have your shorts 5 points away. So if that's what that says, then I need to take a look at that. It finishes around 5 or 6 in the late afternoon, early evening. YM, you should be patient and accept the risk of whatever trade that you put on. Let's see, what should I do here? Okay, already got that. Tim, so I would look at maybe doing a bubble trade up at around the 3. You know what? Yeah. A bubble trade up around the dead zone. Or worst case scenario, you could try and do a calendar spread, but that's going to it's going to be a small debit, and then that's going to force you to hold on to it until literally the last day. Going further out on the longs like Wednesday or Friday instead of Monday. You can do that, Dave, but you're going to obviously your price isn't going to be as good. And if you do that, obviously, if you don't get a price that is as good, you're going to end up with more risk on the pattern, technically. But there's nothing wrong with going out Wednesday or Friday. Matter of fact, there are times where I do that, and my whole intention of doing that is to get out of the short on Friday, and then, for example, if I am long Wednesday, I'll sell another short based on Monday. Or if I'm in long Friday, then we're getting into my long-term approach, and that is something where I can sell an option on Monday, sell an option on Wednesday against the Friday extended long. But again, you have to be aware that you're not going to get as good of a price. Action group 1 is set for day. Should I change it to TCO? No, I will reevaluate this tomorrow. If the market opens up 2 or 3 points tomorrow, for example, I'm not going to do this trade. I'm going to go further out and to where I can get $1, and then I'll do the same thing, right? So only these are all GTCs. So orders. Action group 2, 3, 4, 5, and 6 are all GTC because it's based on whether order 1 gets filled. And if order 1 doesn't get filled today, then none of these are going to matter. Got it? Is the 2 week out of the money trade okay for a newbie? DJ, it's okay for a newbie if you're willing to take the extra risk. Low probability of realizing it, but take the extra risk and you'll find that you actually give yourself a higher probability of producing a larger profit. I love the Q&A. It's extremely valuable. You bet, Wham. Okay, you bet. 4 points are bullish above the same short, but the blueprint suggests. Okay, so if that's the case, I need to go in there and take a look at it. So that's the second one. So it may be a typo, and I'll get that corrected like ASAP. All right, looks like I got all the questions and answers. If you have not signed up, you're going to be missing it. So get signed up, give Spring a call, and she will get you signed up. And I will see most of you on the first session. And again, the first session has already been released, so you actually have access to it. And so that will be replayed, and then I'll be doing Q&A session after the first session. But all begins on Friday, 9 o'clock Eastern, or 10 o'clock Eastern. All right, everyone, have a great week. I'll see you Friday.